We are covering these 8 top actively traded stocks that are bullish today. Our review on GRAB. Grab Holdings Ltd is the powerhouse behind Southeast Asia's go-to super app. From ordering food and hailing rides to sending packages and accessing digital financial services, Grab has positioned itself right in the middle of daily life across over 700 cities in 8 countries. And what really makes it stand out is how interconnected its ecosystem is. Everything works together under one platform, which keeps users engaged and makes the business sticky. Today, shares climbed more than 7%, backed by a strong 84 million shares traded. That kind of volume usually doesn't happen without something real moving the needle, and this time, it was analyst coverage from Phillips Securities. They kicked off coverage with a buy rating and a price target of $5.80, and the market clearly liked what they had to say. So what's driving the bullishness? For starters, Grab's on-demand segment, mainly food delivery and ride-hailing, is showing healthy growth, with gross merchandise value up 16% year-over-year. But the real eye-opener is the progress they're making on the financial services front. Their loan portfolio grew a whopping 64% year-over-year, and they're steadily narrowing their adjusted EBITDA losses, which is a strong signal they're heading toward profitability. What's also worth noting is that Grab isn't scrambling for cash. They've got a solid net cash position, which gives them the breathing room to double down on strategic initiatives, like investing in electric vehicles and tech upgrades, without stretching their balance sheet. In a market that's increasingly shifting toward digital, urban, and mobile-first solutions, Grab's setup looks well-aligned for long-term growth. They're not just riding the wave, they're building it. So when you take that strong market position, improving financials, and a clear growth roadmap, it's easy to see why analysts are getting behind this name. Grab's stock might have had a quiet stretch, but moves like today suggest it could be gearing up for a more sustained run. Our review on NU Holdings Ltd is one of those fintech names that's been quietly but steadily changing the financial game in Latin America, especially in Brazil. For those unfamiliar, it's a digital banking platform that covers the full customer journey: spending, saving, borrowing, investing, and even protection, with a slick app and a really loyal customer base. Think of it as the digital bank that lives on your phone and actually wants to help you manage your money better, not just nickel and dime you. Now, today's move wasn't massive, up about 2.5% on solid volume, 78 million shares traded, but what's happening behind the scenes is what's starting to get attention. 2 big-name analysts just weighed in on the stock, and both came in strong with bullish calls. Morgan Stanley reiterated their buy rating and held firm on their $18 target, while JP Morgan actually upgraded the stock to a buy with a $13 target. That's a decent range, but the underlying message is consistent. There's growth ahead. What's interesting is how both analysts are leaning into Nu's potential in payroll loans, a new lending product they're rolling out. Initially, there were some concerns this could eat into their more profitable unsecured loans, but Morgan Stanley's Jorge Curry thinks that's overblown. Turns out, there's not much overlap between the customer bases for the 2 products, and payroll loans offer lower loss ratios, more predictability, and a whole new lane of growth that could help Nu expand its footprint even more. Then there's the big picture from JP Morgan's Yuri Fernandez, who's seeing this recent dip in Nu's stock price as a buying opportunity. He's calling for more than 30% earnings growth over the next few years, which is no small feat, especially in a market that's been anything but generous when it comes to fintech names lately. And he gave Nu credit for strong execution and consistently beating expectations. So while today's move might not scream breakout, the setup is quietly strengthening. Analysts are warming up, new products are rolling out, and Nu's track record is making a case for more attention heading into the rest of the year. Our review on CVS. CVS Health Corporation, The well-known health solutions giant covers everything from insurance plans and PBM services to in-store pharmacies and virtual healthcare. Whether it's your local CVS pharmacy, Aetna Health Insurance, or specialty care through home health services, they've got a hand in nearly every corner of the healthcare space. Now, today's stock move, up nearly 6% on 24 million shares traded, is catching some well-deserved attention. And while at first glance it might seem like another bounce following the broader market rebound, there's actually a bit more going on under the hood here. CVS just announced a pretty meaningful leadership shakeup. Brian Newman, former CFO at UPS and longtime exec at Pepsi, is stepping in as their new chief financial officer later this month. That's a big move, especially given Newman's track record managing finances at massive, complex organizations. The current CFO, Tom Cowhay, isn't leaving the building though. He's moving into a strategic advisory role, which signals continuity while also opening the door for fresh thinking at the top. On top of that, they're also bringing in Amy Compton Phillips as the new chief medical officer, someone with deep experience in performance improvement and healthcare leadership. But here's the part that likely tipped the stock higher: guidance. Alongside these exec changes, CVS let investors know it expects to meet or exceed its 2025 full-year outlook. That's the kind of low-drama, high-confidence update Wall Street loves, especially for a company that's been in the spotlight lately over cost pressures and shifting healthcare dynamics. So between the shakeup in the C-suite and a reassuring business update, this wasn't just a relief rally, it was a confidence builder. Leadership transitions can be tricky, but when you bring in experienced names and pair it with a business that's tracking ahead of plan, it tends to get the market nodding in approval. CVS just reminded everyone it's still a heavyweight in the healthcare game, and it's planning to stay that way. A review on VG. Venture Global Incorporated is one of the newer heavy hitters in the U.S. LNG space, building out a serious portfolio of liquefied natural gas projects right along the Gulf Coast in Louisiana. Their strategy is pretty clear: control the whole supply chain from production to export, with 5 major LNG terminals either in development or already getting close to operational. These are massive projects designed to tap into abundant North American gas and ship it to global markets hungry for cleaner energy sources. Now, let's talk about that nearly 12% pop in the stock today on 18 million shares traded. That's a big move for a company still working its way through the project build-out phase. This kind of jump usually signals more than just good vibes. It likely reflects a shift in sentiment around their long-term potential. There hasn't been a flashy headline yet, but here's what might be driving the enthusiasm. Venture Global has been steadily gaining attention as global demand for LNG continues to rise, especially with Europe still trying to diversify away from Russian energy and Asia ramping up its cleaner fuel intake. Investors are betting that once these terminals come online, Venture Global could become a major revenue engine. The sheer scale of their projects, over 140 million tons per year in total peak capacity, is no small feat. That kind of output, once operational, could rival the biggest names in LNG. And with other LNG stocks heating up lately on expectations of long-term export growth and favorable pricing, Venture Global seems to be riding the wave. A move like today's also suggests that institutional buyers may be positioning early, seeing value before the revenue really starts rolling in. So while we're not looking at confirmed news just yet, today's price action tells us the market is starting to take Venture Global a lot more seriously. For investors, it's a sign to keep this name on your radar as the global energy transition keeps pushing demand for U.S. LNG higher, and as these massive Louisiana projects start flipping the switch. A review on UNH. UnitedHealth Group Incorporated is one of the largest healthcare companies in the U.S., running 2 massive businesses: UnitedHealthcare, which handles a broad range of insurance and benefit plans, and Optum, which provides everything from pharmacy services to data analytics and care delivery. It's the kind of company that sits right at the intersection of healthcare policy, technology, and insurance, and when something shifts in that ecosystem, especially around Medicare, UnitedHealth feels it immediately. So today's move, up over 5% on 11 million shares traded, definitely grabbed attention. The spark here? A surprise announcement that Medicare Advantage payment rates are going up in 2026 by about $25 billion across the board. That's a pretty meaningful jump and way better than what many in the industry were bracing for. Just a few months ago, there were concerns that cuts could be coming. So the fact that we're looking at an increase instead? That's a sigh of relief moment for the entire sector. UnitedHealth, being one of the largest providers of Medicare Advantage plans, stands to benefit big time from this. It removes a major overhang that's been weighing on the stock. Investors have been jittery about margins tightening under government pressure. This update flips that narrative. Now we're looking at a more stable, possibly even more profitable outlook for their Medicare business, which is a core revenue driver. And it's not just a sector lift. This is specific to UnitedHealth as well. The company's shares had been down around 10% over the last 6 months, partly due to fears around rising medical costs and policy uncertainty. Today's bounce shows that those worries are easing a bit, and it gives the market a reason to reprice the stock more favorably. Bottom line, when the government throws a curveball, in this case a positive one, it matters. For UnitedHealth, this rate hike gives them breathing room and potentially stronger earnings growth in the coming years. Investors are responding exactly how you'd expect, by jumping back in. Our review on CLOV. Clover Health Investments, Corp is a tech-forward healthcare company focused on improving Medicare by giving physicians better tools and seniors better access to care. At the heart of their strategy is Clover Assistant, a data platform that helps doctors catch and manage chronic conditions early. Now, the stock popped over 8% today on 11 million shares traded, and there's some solid momentum behind that move. First, they just announced Dr. Shelly Gupta as their new Chief Medical Officer. That might sound like routine news, but Dr. Gupta brings real weight. She's a veteran from Humana, where she helped lead Medicare plans and launched Medicaid programs, so she's not just filling a seat, she's bringing some firepower to Clover's clinical operations and disease management push. That kind of leadership appointment is especially relevant for a company like Clover, where tech meets care delivery. Gupta's background in precision health and value-based care lines up perfectly with Clover's mission. She's expected to have a big hand in driving their chronic care and quality initiatives forward, key areas that could really improve patient outcomes and margins. Adding fuel to the rally, analysts are showing some love again. Craig-Hallum reiterated a buy rating, and the average price target sits nearly 48% above where shares are now. It's a vote of confidence that the market needed, especially since insider sentiment has been a bit cold lately with a few notable sell-offs. So this bounce isn't just about one headline. It's a combination of a strong new hire who fits the mission, renewed analyst optimism, and a bit of market recovery mood. For investors keeping an eye on Clover, today's move might be signaling a little shift in tone, and possibly in trajectory. Our review on CVNA. Carvana Company is a holding company that runs an e-commerce platform built to reinvent how people buy and sell used cars. Everything happens online, from browsing to financing, warranties, and scheduling delivery or pickup, even from their signature car vending machines. They also offer trade-ins, same-day delivery in some markets, and even customer service reps to help guide buyers through the process. Think of it as a full-stack digital car dealership with a futuristic twist. Today, Carvana's stock popped over 5% on 10 million shares traded, and the excitement is tied to some fresh bullish analyst commentary. Citi just reiterated a buy rating and set a $280 price target, pointing to some really strong first-quarter momentum. According to their proprietary data, Carvana's retail unit sales surged 46% year-over-year, way above expectations. That kind of growth is impressive, especially in a market still feeling the pinch of macroeconomic uncertainty. Even more telling is how Carvana is handling its inventory. They increased average weekly inventory nearly 18% quarter-over-quarter, which shows they're not just chasing demand, they're anticipating it. That kind of strategic inventory management is key when you're scaling up efficiently. At the same time, average transaction prices have dipped slightly, but analysts think Carvana's tighter operations and efficiency gains will offset that, potentially boosting profitability. And it's not just Citi feeling the good vibes. JMP Securities also doubled down on their buy rating with a $340 price target. So while the stock is still viewed as high risk, the tone around Carvana is shifting. It's less about survival now and more about execution and upside. Bottom line, Carvana's no longer just riding on buzz or flashy vending machines. The numbers are starting to back up the story, and Wall Street is giving it a second look. If they can keep up this kind of disciplined growth and efficiency, there could be more room to run. Our review on ALHC. Alignment Healthcare Incorporated is revolutionizing senior healthcare with its consumer-focused platform, offering Medicare Advantage plans across several states. The company uses its AVA technology to streamline care and connect members to 24/7 concierge services, enhancing the overall healthcare experience for seniors. Today, the stock saw a solid bump of over 6%, following an upgrade from Stifel Nicolaus, which raised its price target from $18 to $23. The boost comes after a strong earnings report, with revenue rising from $465 million to $701 million. But the real game changer is the recent CMS rate update for 2026, which exceeded expectations and could benefit Medicare Advantage plans like Alignment's. While insider selling has been on the rise, analysts are still bullish, with a moderate buy consensus and a price target suggesting room for growth. The stock's recent uptick reflects confidence in its ability to capitalize on favorable Medicare trends, though investors should stay aware of potential risks. Please subscribe, give the video a like, and watch more from our playlist. Thanks.